traders at UBA say investors' attention are tilting to long-dated on the run bonds as yields on the 2042 and 2050 papers record an uptick. We have Chuka Nwachukwu, who is the head of ALM and balance sheet management at UBA. He joins me now for an update on the market. Chuka, thank you so much for your time, and let's speak to the sentiment we're seeing in the market this week.
Okay, thank you, Ken. Like you mentioned, this week started with a bond auction on Monday, where we saw 360 was on offer, and then 368 was sold across four maturities of 2028, 2032, 2042, and then 2050. The 2028 was printed at 14%, 32, 14.8%, and then 42 was printed at 15.4, and then 50 was printed at 15.8. Going into the week proper, we've seen a decrease, especially on the 2042, like you mentioned earlier, and 2050. This is because a lot of traders who lost at the auction were trying to cover at the secondary market, and that's what has actually driven down the yield slightly.
Because I was just going to ask you if you'd say that the PMA result from last week is dictating the tone of the market as we go into the rest of this week.
Yeah, the PMA actually dictated, but again, what is dictating the activity in the market largely is the liquidity constraint we're having. Like you know, the system has been in repo over a month now. And so that really affected the bond auction we had. If you see that the most of the attractions, and then about well over 70% of the bond sold were on the longer end, which is 42, and then especially on the 50 side. So liquidity has actually affected the sentiment, and this will continue till maybe towards the end of the month.
Yeah, because I'm looking at coupon inflows coming in, still not enough to solve the issues there. But let's get to a bond. Let's look at the bond auction and look at that update and how you see sentiment comparing with the previous auctions. What trends are you seeing play out?
So the auction actually did not follow, like I said earlier, did not follow the last auction in terms of bullishness and in terms of participation. So it all boils down to the liquidity in the system. And again, what actually has happened again is that most traders went short on the longer end, which is the 42 and then the 50. So they all try to cover in the market, and that's why we see a deep press in the yield on those two bonds. Going into next week, we seem to we probably will have a respite. There will be a lot of liquidity coming into the market next week, and that will actually affect the way trading will go.
So, but how does that affect how investors then position post-auction then?
It will affect, because now is the best time for any investor who lost at the primary market to try to cover the position. Because next week there will be a lot of liquidity, and then this liquidity will be chasing a few instruments in the market. For example, the one-year bill that came out last week, it came out at 14.74. It's currently 14.7. It's currently trading at below 11.5. So that's obviously will tell you the sentiment that will be going into next week. Lest I forget, like you mentioned earlier, there was also a coupon payment. Well over 135 billion was paid into the market, yet the market is still very tight, and so liquidity has really driven the activity.
All right. As we wrap up, I just want to find out one key thing, though. It's more or less how investors are looking at the corporate bonds in the market.
Yeah, the investors are obviously looking at the corporate bonds in the market, but again, they need to benchmark it with the FGM bond. And so if any investor is coming in to invest, you have to probably look at the FGM bond, which is more liquid, and so that will obviously give them an idea what yield or what rate they will hope to invest in.